Shana, great to see you. Thank you so much for joining us today on Alts Expo here at WealthChannel. How are you?
I am okay, and I'd like to thank you for having me. I want to thank the participants for joining to hear my presentation.
Without further ado, I'll let you go ahead and take it away. I'm going to go off camera and microphone. The stage is yours.
Awesome. Hi there, everyone. I wanted to take a moment to just let you know the presentation is going to be focused on why and how you should use alternative investments in portfolio construction right now. For background, Banríon Capital Management was launched a little over a year ago. We just celebrated our 1-year anniversary. And the main framework and foundation for what our company was built for was to help financial advisors and their clients be able to scale allocations to alternatives, no matter if they were accredited, qualified, or not. The goal here, of course, is to provide more diverse, better portfolios for clients to be able to have less volatility and be able to take advantage of risk opportunities in the market without adding substantial risk into the overall portfolio. So the framework for which I will be presenting today is with that in mind. So just for a little background, I know I'm not telling anybody anything they don't already know, but monetary policy has changed substantially in the last 3 years. The last 2, most notably, we've started to see interest rates rise in the last year for the first time in almost 2 decades. But this is something that was a long way in the making. And quite frankly, we have an entire generation of investors who got really used to zero interest rate policy, thinking that that's normal, and it's not. We are actually up to more normalized rate environment, and that means that portfolios that were traditionally 60-40, they're not dead like a lot of people like to claim, but they certainly might need to be reinvented in a way. And that's where I think alternative investments can really play a role. You know, in the last, say, since the financial crisis, nobody wanted to talk about alternative investments because you don't have to when equities are going straight up. Nobody's really worried about risk. You have a zero interest rate environment, so fixed income is kind of chugging along, and you have great returns, highly unusual returns from equity markets. In fact, over that period, we saw equity market returns far larger than the long-term average of 10%. I believe the overall average for the S&P 500 over that period was closer to 15. So highly unusual, and an entire generation kind of built portfolios for that environment. But the truth is that's not a normal environment. What we are experiencing now is more normal, and portfolios need to evolve in order to perform well and have lower volatility in the new environment. As you can see, this is a little dated. We're showing treasuries at the end of last year at 3.88%. Now we're well over 5%. So this just gives you an idea of how things have really changed, even in the last not even 12 months. And this is just a quick look at what a traditional 60-40 portfolio has done, how it has performed over the last, you say since 1950. You know, if you think about it, though, there are some periods here where it didn't work. And I think as we move into this environment, and as we have greater accessibility to alternative investments across the board, we have a great opportunity here, not only to diversify portfolios, but also to align portfolio investments with your passions. Alternative investments, in addition to being an excellent diversifier and source of excess returns if used properly, and if selecting the right types of investments for you, can also align with things that you're passionate about. Alternative investments can include everything from, you know, hedge funds, private equity, private credit, but also can include things like sports rights. They can include things like antiques, music rights, oil rights, royalty rights of all different kinds, art, and the like. So there's really an opportunity here, and with the breadth of the market growing and the accessibility of the market growing, to look for ways not only to enhance your portfolio diversification, improve your returns, but also find ways in which you can align your portfolio investments with the things you're most passionate about. I won't go through this too much because this is, of course, what we've been talking about, but I want to have special focus on that last bullet, which is that regulatory changes in 2007 resulted in greater access to liquid alternative products, providing access to alternative strategies for all investors. This continues to evolve as we have the advent of interval funds and other types of products making alternatives accessible for everyone. The good news is that it does allow all investors to take advantage of the diversification benefits. But the negative, of course, as with anything, as you see, the broader the availability, the harder it is to achieve alpha. So it still makes sense in my mind for folks who are accredited or qualified to focus on private fund offerings. But I do think it's important to note that alternative investment diversification benefits can be achieved by all investors, regardless of whether or not they meet the accredited hurdle or not. This is just a quick look at what a portfolio improvement you can see if you allocate 20% of your portfolio in a traditional 60-40. And let me kind of explain what I mean by that. If I have a client, or if you have a portfolio and you have $1 million in it, you would take 800,000 and put that in your traditional 60-40, and then you would take the remaining 20% and put it in a diversified bucket of alternatives, not just one product. And I will get into this a little bit, but also keeping in mind that things like private equity and private credit are still credit and equity and do have higher correlations to the traditional public markets than, say, something like a hedge fund that is long short or equity market neutral, or some sort of arbitrage strategy where there is a clear investment strategy there that's looking to diversify and have less correlation to traditional markets. I think a lot of us want to put all alternatives in one bucket, but that's not really the case. There's lots of different ways that you can leverage those private vehicles to get better returns and to take advantage of less efficient markets, but they are still correlated to traditional equity and traditional credit. This is a great chart from JP Morgan showing exactly the same thing my previous slide showed, but using 30%. It goes back a little bit further than my own chart because my chart takes into consideration the 2007 advent of that allowed for hedge funds to convert some of their product into mutual funds, and after that ETFs, and now the newer interval fund products that are allowing for access to less liquid alternatives like venture capital and private equity. But I do think this is very powerful. What you see here really is an improvement in returns with less risk. And, you know, it's not a massive improvement in returns, but if you look at, say, the 80-20 fixed income, you have volatility of 12.82% with annualized returns at 9.18%. If you look at that, in this case, they're using 30% alt. That very last bucket, it's 30-50-20, which is sort of their equivalent to the 80-20. You see a substantial decrease in volatility and a slight increase in annualized returns. And at the end of the day, for long term, even if it's only 40 basis points or 30 basis points like here, it actually can have a huge impact on your total portfolio returns over time. So what defines alternatives? Like I said, it's anything that's not long only equity or fixed income, can be public or private. And I went through some examples there. Again, want to kind of focus on the fact that just because it falls into the alternative bucket does not mean it's a diversifier. And the focus of this presentation is really on using diversification as a benefit. So while we will touch on some of the private equity, venture capital, private debt, I do want to focus more heavily on the things that do provide extra diversification benefits, which are things like commodities, managed futures, long short equity, equity market neutral, real assets, real estate. And while unpopular at the moment, crypto also falls into this bucket. There are many different ways to gain access. As I touched on, I do believe for accredited investors, if you are qualified, you will receive better product opportunity in the private funds. So LPs, private placements, keeping in mind that traditional hedge funds have greater liquidity because they're basically taking private market investments and just doing diversifying types of investment strategies by going long and short in multiples of different ways. which is very different than your traditional private placements, which we call drawdown funds that have capital calls and long lockups that don't have that kind of liquidity. Again, they tend to be more in the private equity, private debt, venture capital, venture debt realm, and they do have greater correlation to equities and fixed income than some of the more diversifying hedge fund, LP kind of products. SMAs, interval funds, mutual funds, and ETFs are all other ways that you can gain access to alternatives, although those universes are severely limited. And that's why I say if you're accredited, it does make sense to look at the larger universe of opportunity that is available through LP solutions and private products. The interval funds, mutual funds, and ETFs all have benefits for investors who can't qualify, but they do have their own limitations. The regulatory environment and the regulators did restrict the amount of leverage and how much shorting can be done. So in many ways, they can't diversify as well as the private products. Above and beyond that, interval funds, while a fantastic new way for all investors to gain access to less liquid opportunities that have never been available before, do have severe liquidity limits that need to be noted when talking to clients or when considering them. They're not very liquid. You cannot at any time redeem your entire investment. You can usually on a quarterly basis get a portion of your investment back, but it's still going to have liquidity constraints. And as we've seen recently with a number of headlines, a lot of investors aren't informed of that and then feel surprised when they go to redeem and find out, oh no, it's not actually as liquid as I may have thought. So just food for thought. And again, I know most of our audience here is accredited, so it makes more sense to be in these private products. It's a much larger universe of offerings, but it makes sense to work with a professional if you're going to be in that space, because due diligence plays a very important role to avoid, unknown risks or potential operational risks of the firms that you invest in. You don't have the benefit of a regulatory framework that the 40 Act funds have to survive under. And I always like to note, even in that space, there have been plenty of operational problems at firms that have led to, massive blow-ups of firms. But it is especially important when you're dealing with a private space to deal with a professional who can do the proper due diligence. It's actually something that Banríon provides for all of our clients. As you can see, there are a lot of diversification benefits, but again, want to focus here. If you look down at, say, venture capital and private equity, and you compare it to, say, global equities, you will see that these do have higher correlations, 0.8 and 0.7 and 0.5. Some of the long short, again, will also have high correlations. It is really important that you keep that in mind and look at, the green on here indicates low correlation, and there is plenty of that to be found. As you can see here, hedge fund correlations with a 60-40 portfolio fall during periods of stress. And again, this is going to provide quite a bit of protection and reduce volatility in portfolios if you include an allocation to alternatives into your portfolio. We stick with a 20% recommendation at Banríon. Anything more than that, you get into a number of operational risk concerns. And also, because these are low correlation, we're not saying that equities aren't the best long-term opportunity for excess return, because they are. But we also aren't, naive enough to think that markets just go straight up and there's not benefits of diversification. We all learned that as a basic tenet of portfolio construction. And that's what you're seeing here, is that benefit during periods of stress of hedge funds, as they tend to fall in correlation to traditional 60-40s during that period of time. There's things to note. I won't go into this too much because it's not as important, but there, again, to focus on why, if you can qualify for some of the private products, it makes more sense. There is alpha in illiquidity, and that's why private equity does tend to do better than traditional public equity. That's why venture capital tends to have outsized returns. The best investors tend to have outsized returns because of the illiquidity benefits, and the lack of information available in those markets allows certain managers to have an information edge. Talking just a little bit about access, we've gone through this already. If anybody wants a copy of this presentation, I'm happy to provide it if they just want to reference this. But this just talks about the pros and cons of the different options. The 40 Act funds, which are your mutual funds, interval funds, ETFs, are daily liquid, and a lot of people are much more comfortable with that, but there are limitations, and there is alpha and illiquidity, so those private products can make a lot of sense. I love this chart so much. This is from JP Morgan's Guide to Alternatives, and I apologize, I didn't update it with the most recent quarter, but I do think it's really important to look at, what this shows is similar to the Ibbotson chart that we've all gotten so comfortable with looking at, where it has small cap, large cap, value, growth, global, domestic, all in one chart. This is the same thing, but doing it with alternative strategies. And as you can see here, for example, at the end of 2022, global macro and equity market neutral were the top performers. They actually did significantly better than global equities and global bonds. And again, this just plays to the continued focus that we believe at Banríon, and that is kind of the focus of this presentation, of the diversification benefits of these types of products in a total portfolio. This gets to the point I was making about the importance of working with a professional. There is a lot of dispersion of returns in this space, private market. Actually, I feel very strongly that in the hedge fund world, smaller boutiques are where you want to be. In the private equity world, larger funds, venture capital too, are the best players. So knowing and understanding that's important, and doing your research is important. So working with a professional is really, really important as you start to look at some of these types of products. This just gets into the private versus public opportunity here in terms of more opportunity coming from the private markets as we see more and more companies going private and less companies listing. And this kind of shows you how the sector weights also work. As you would expect, there's a lot more technology companies in that private space than in any other sector. And this is in small caps, which I think is a relevant comparison. This is just talking about the different types of drawdown funds. It's worth noting that in the private equity space, these types of funds have substantial lockups. You need to be prepared for that, but also have high correlation to equities. And there's different ways you can play this space. Venture capital and growth capital are kind of the area that we at Banríon have a lot of available on our platform. Larger buyouts tend to do best if you deal with some of the bigger players like the Carlyles and the Blackstones of the world. Yeah, this is just getting into some kind of like the business activities in that area, which I don't want to focus on too much because, again, I don't find those products are particularly diversifying. The structure of these products have changed substantially over time. As you can see here, we have classic limited partnerships and feeder funds, but now we also have interval funds, auction funds, tender offer funds, things of that nature, which provide a greater availability of opportunity in the alternative space, but also greater ways in which people can invest. As you can see, some of the more classic private funds are not eligible for our IRAs. They have K-1 reporting, which makes tax time a little more difficult for a lot of people, which are all things worth considering when you're considering investing in the space. Just a little background around me. As I was introduced, I received the nickname of Queen of Alternatives from Cynthia Murphy over at Tidal. It has more to do with the name of my company than anything else. Banríon means queen in Gaelic. And so that's kind of where that came from. I have 22 years of industry experience, and I have been involved in the alternative space doing due diligence on alternative managers since 2007, and have worked in that space. I've received a number of awards. I won't brag about myself anymore. I want to get to the questions. And here are currently some of our platform partners here at Banríon. As I noted, Our focus is to help investors and their financial advisors scale and use alternatives as a diversifier. And we do that by finding good partners to work with that we think are going to work well with advisors and their clients, be easy to access, to have, if you have questions, and that have products that make sense. So we actually really screen all of our partners before we add them to the platform to make sure that they're going to be that kind of partner for their advisor and the clients. At Banríon, we also make ourselves available, and we're always happy to answer questions, even if you're working with somebody not on our platform. And this is just how to contact us. So with that said, I'll kind of leave it here and open it up to questions.
Yeah, great. Awesome presentation, Shana. Thank you so much. Biggest question I have for you is, what has been the biggest challenge for retail investors allocating more to alternatives? You know, I presented earlier this morning in my keynote address, I mentioned that according to McKinsey, only 2% of retail investors' portfolios are allocated to alts. And so I guess two-part question. One, why is that? Why has it been challenging for retail to get into alternatives? And then two, how do you expect that to grow over the coming years?
Well, I think it's been difficult for retail to get into the space because of lack of education. Again, retail investors aren't able to access some of the private product that's been around for a long time. And the categorization of alternatives in, the 40X space leaves a lot to be desired. I'll give you an example. I was once looking for a global macro fund to add to my portfolio, liquid alt portfolio that I run here at Banríon for our clients. And I found global macro funds in 4 different Morningstar categories. So, there's that problem. It's hard to compare across, say, market neutral strategies. If you do look at the category, they're all drastically different in how they do their approach. So you can't compare one to another very easily. It's not like large cap growth where they're all kind of doing the exact same thing. That's not true in the alternative space. And there's complexity here and lack of understanding. The fees are higher. People get a little scared of that. And if you just think about it, the majority of retail investors invest through their 401k, and most 401k plans do not offer alternative investments as an allocation option within them.
Great answer there. We are running a couple minutes behind. We do have Stephen Pesavento with Von Finch Capital joining us in just another minute here, but we had a couple more questions for Shana. I want to make sure that we give her full time allotment. Stephen, sit tight. We'll get to you in just a minute or two here. Another question coming in asks, does Banríon publish any due diligence, or how is that information available, Shana?
Sure. So Banríon does due diligence on all of our platform partners before they're made available. And we do make our due diligence reports and our due diligence questionnaires fully transparent on our platform for our clients. So we do not publish it publicly, but for any of our advisor clients and their underlying client portfolios, we make our due diligence completely available for all of our platform partners. Yes.
Yeah. Question here from Brad. It's a little bit unclear to me exactly what he's asking, but Brad, I'll try to do my best with this one. I think he's asking, can you give us the diversity that you recommend in your 20% allocation? 2 managers, 3 managers? What do you recommend?
Oh, I know exactly what he means.
Okay.
When we build traditional equity portfolios, we do large cap growth, large cap value, mid cap growth, mid cap value, small cap growth, small cap value, maybe some core, maybe take some sector bets. You do similar things in fixed income. He's asking the same question as it relates to alts. I typically look for 5 funds, and I typically look for 5 different products that are not correlated to each other or traditional equities. So for me right now, what that portfolio looks like is I have an equity market neutral product called BTAL, which is long short volatility. They call it a low beta, anti-beta fund. I have that. I have a global macro fund, a managed futures fund. Sometimes that can be straight up commodities. Right now it's managed futures because that's just does better in the environment we're in. I use a credit arbitrage strategy. And I also at the moment have a strategy called MRSK, which is an option-based strategy that acts almost like a buffer strategy, but without the caps on the upside. And that is my way of kind of adding slightly more opportunity for risk in the portfolio, but it still is a substantial diversifier to the overall, and it's a diversifier to the portfolio. So I generally think about it as 5, and I don't put private equity and private credit in what I consider my 20% alt sleeve. When I work with clients, I really focus on, if your client is qualified and comfortable with illiquidity, we should have a 5 to 10% sleeve of private equity or private credit in their traditional equity and fixed income allocations, because they are highly correlated to each other, but greater opportunity for excess return because of that information edge and the opportunity to take advantage of less players and less information in this space.
Great. Thank you for the insights there. Kevin asked a question that I'm going to answer. He wants to know, hey, how do we get Shana's slide deck? How do we get other slide decks? We're going to put all of these slide decks on our website at the Alts Expo webpage. You can find that at wealthchannel.com/expo. It'll be on the same page that you use to register for today's event. We're going to email everybody once we get all those decks up. Give us till tomorrow. We're going to get all the recordings up there. We're going to get all the slide decks up there where our sponsors and our presenters want their decks to be shared. We might have 1 or 2 where we don't share those publicly, but the vast majority of them will be online by tomorrow. So wealthchannel.com/expo. Shana, thank you so much for joining us today. The Queen of Alternatives from Banríon Capital Management. Thanks for your insights, and thanks for your support of Alts Expo. Really appreciate your time, Shana.
I've really enjoyed being here. Thank you.